Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook and your host for about the next 25 minutes here on Options Guide TV. So on Friday, we put a haphazard trade together for the SPX. I think you could tell I was a little bit trepidatious. We had to pay too much for it. We got it on a little bit late in the day, but it actually worked out just fine in that the marketplace really didn't do much on Friday. And if anything, it leaned a little bit bullish overall, and it was okay if you put the trade on. I'm not going to go back and rehash it. That was just a half a day trade using 0 DTE options. But when the VIX comes down and is hanging around the 14 level, just volatility in general. Now, 1 day volatility matters more than the actual 30-day volatility, which the VIX is. But it gives you kind of just a good feel if you look at the VIX to see where those vols are at. And the lower the implied volatility, the harder it is to do 0 DTE options. I mean, I guess it's a catch-22 in that if you're doing a butterfly, you kind of want the market to stay where it's at. We always lean either bullish or bearish, but so more volatility in theory means that the market can move more, and that's the reason why it is volatile. So it's a catch-22. You're paying less for the butterfly up front, but then you have more propensity for the underlying stock to move. And I just like to have less upfront because, the overall risk. I just don't want to. I want to pay less for the butterfly and have less risk. Now, it obviously depends on the number of units or butterflies or contracts, however you want to say it, that you're doing. But that's the way to approach it, right? So I'm going to go back, and I still like the way the gold chart is. Unless you've been living under a rock, you wouldn't, or if you're not following the markets whatsoever, by the way, it is Fed week. So we're going to have a real big announcement on Wednesday. And so because of that, I don't want to do an SPX trade. The VIX is up and the market is up. We have the market right now trading. Let me make sure I got it here. It is up about a little less than 1%. And we have the VIX creeping a little bit higher, but it's mainly because of the Fed speak. So the VIX is up 42 cents and it's trading above 15 at this point in time. It's at 15.19. And we have the SPX right now at 6,617. It's up 33 points on the day, or about 0.5%. I feel like the markets are, waiting to see. It's pretty, as far as the Fed funds futures are concerned, and the Fed watch tools over at the CME, there is hardly any probability at all that they will not cut. And going out in time, it's still showing that next meeting after this one, they're still thinking about another 0.25% at least. So I guess the biggest question would be, could they possibly go 0.5%? There is a small percentage chance that could happen, according to the Fed funds futures. And how many dissenters might we have? Nowadays, there's some volatility in that. So some people could dissent saying that we don't need to cut rates, and some might say that dissent saying that it should be 50%. So it will be real interesting to see the conference afterwards. There's a little bit of excitement going on. Might actually get some news after in the conference call that is not just I don't know that could really move the markets. So I think that's what we're seeing in the VIX. That's up. And the market's being at a high. This could be a reason to, buy the rumor, sell the news. And you could see a little bit of a sell-off because of that. So I just this week in the SPX, I'm a little bit nervous about what has happened. So here's my attitude. Here's what my thought was going into the week is let's look at gold again. We did an open wing butterfly to the upside, and that trade worked out well. It is a Monday. It's once again a $300 stock, and 337 is where gold is trading as far as the ETF is concerned. It's had a real big run up, and it's up again today. So I'm going to flip the script a little bit, and I'm going to get bearish on gold. I already set up a trade that I don't mind at all. So let's run to the Tradier Pro software. And first of all, let's start by just looking at where gold is at. So here's the big run up. Okay, so this is going all the way back to last year. Strong move, a little bit of a period of consolidation, and then another leap up from basically the 310 area to the 340 area. And now we're having a little bit of that consolidation period once again. Now, you're seeing some chop in the market up today. I think if we're talking about buy the rumor, sell the news in the SPX, I think there's more of a chance of it happening in the gold. In that, if the Fed does what is expected, it might be a chance to sell off some of this gold position where people have had some gains. So I'm going to get bearish on it, and ultimately, gold is fickle. You're not looking at the fundamentals of gold overall. So I'm going to get bearish on it, and I could see us actually going back to the wheel later on and getting bullish if we get a little bit of a downturn and we get down in this range, down where the stock kind of stalled at, right around the 330 level, 333 level. That would be my ideal scenario. So we're going to set up the trade to go around that. All right, so here we are. Fed week, we're trading gold. That's simple. 337.20 is where gold is at. We are going to go out and use put options because we are going to be bearish on this trade. We're going to buy the 342 strike put. Oh, I should probably mention the expiration. We're going to go up to this Friday. So it's going to be a shorter term trade. I think the last time we did the gold trade, we probably went out a little bit more than 10 days or so. We're only going 4 days here. We're going to buy the 342 strike put. At the same time, sell 2 of the 336 strike puts. Not quite at the money, right? We're just a smidge down below. And then we're going to stop short and do the 334 strike put. We can get this done for $300. Maximum upside would be the difference between this strike. This is our long call, or our long put spread. That would be our maximum from here. So from 342 down to 336, that's 6 points. So that's the most it could trade for. And then if the market continues on down and we stop short, right? We only went down $2 and then bought this option contract. So with that mentioned, then this is 6 minus 2. That means this could trade for 4. If we put it on for 3, the market goes below 334. And 334, right? If it goes below that, we can make $1 on this trade approximately. So let's call it $3. Let's make it 3. 295. We'll just make math real simple on this one. For my screenshot, we'll put 3 in there. All right. And we send it to the what if calculator. Let's send it right now. See if we can get that 3 to show up. And then, so here we're showing. So it's saying that it's 295 because it's giving you an extra $5 if the market goes this way. So here's our profit and loss graph. Market is right here. Ideally, it sits somewhere in this range, and we're looking wonderful. If it goes all the way down, no worries. We can even hang out to see if it will come back. Our main thing is after the Fed, if it makes a strong move to the upside. And by the way, I want to highlight this too. That's almost a 1 standard deviation move, right? If we look at the call side of things, it's saying there's a 25% chance based off of the delta that this option contract would finish 1 cent in the money, and we'd lose this $3 on this trade. And then also, if you do the math and you say, okay, we paid $3 for it, our break even, our 1 break even point is going to be 342 minus $3. Or 339. So the market could actually move up a smidge and we're still going to be break even. And that's going to be highlighted here in the what if calculator, right? That's right where our market is at for our break even on that trade. So we if the market just stays where it's at on gold, we're good. If the market goes down, we're even better. If the market drifts up, we're okay. The market finishes way up, we're not okay. So we have one scenario where the market finishes above 342 by this Friday after the Fed speak. after the conference call, after all that stuff, and the market is above this level, that is where our risk is at. So ideally, we don't want it to go above 339, which is our break even. But even if it does right after the meeting, you would look to get out of this. Well, you can get out of the trade whenever you'd like, but time decay is your friend if you're correct on your forecast with gold. This Friday, we're going to want to get out of the trade. Don't forget that this is not a cash settled index. This is not the SPX. So there's going to be obligations that could happen in this trade. So you want to make sure you close it out, or you could end up being short gold on Monday without knowing it. You could get auto exercised on your long put and sell some gold. That would be a bad thing, right? Oh, good morning, Kurt. Thanks for joining. I see you in there. Go ahead and toss that one up. Appreciate to know. It's always good to know that, I love everybody saying hello and good morning and how's your coffee, that type of thing. Cause then I actually know that I am talking to somebody out there and I'm not just talking to YouTube. I appreciate that. So thank you, Kurt, for joining us. Here we are, $3. All right. I like that trade. I do. Like I said, a little toppy, opportunity to sell off a little bit on gold. I do think, just in general with the toppiness of the marketplace, it makes sense to me that gold is trading near an all-time high. Well, at an all-time high, I should say. And this is this one opportunity to sell it off. All right, so UNH, we've been going back, and one of the things that I like is these $300 stocks. When you're looking at these butterflies, they're so much easier to set them up on more expensive underlyings. Selling a 2-point wide spread is always hard to negotiate. The pricing does get a little bit weird with them. Like say if you're in the SPY versus the SPX, the small spreads when you're doing them are just a little bit weird to me to trade. And they do have different pricing dynamics. So I do like a little bit more expensive underlying. UNH has became obviously one of my favorites. I've talked about it a lot on the show. We've rode the wave of butterflies in UNH, and we got another one on. Market is down today though, but it did fairly decent last week. Let's go pop in on the chart on UNH. All right, so there's the big move up. Here's the gap that we're trying to fill. So I'm going to concentrate on that gap. So I'm going to grab it right about here and we're going to zoom in. And so we got it from this toppy point, 360, all the way, there's room to run until we get all the way up to, let's call it, and my eyes are right here, right? That's where my eyes are at. We're going to say 337, 370. Let's go 375.50. All right. So look how much room that gives us. 15 points easily. Now we're all the way down at the 350 level. So I don't mind getting long this again, but we're going to let this one trade play out, see if this gap gets filled. And if it comes back down, well, that would be a real bearish sign, right? If we come back down to this level, there's going to be a level of support right around here, right about where this breakout is. You see 1, 2 areas in here. But right now, I like the setup that we have on our trade, even though it's down today. Let's go look at what we got going on in UNH. 365, I think, is what we ended up paying for it. Yep, 365. All right, let me pull it up. I got it somewhere pulled up. All right, I'm going to have to zoom in. 335, 345, 350. 335, 345, 350. So we're right in the middle of it. We have the September 19th expiration, 4 days away. 335, 345, 350. I'm squinting my eyes. Can't see like I used to. 345, 335, 345, 350. Buy. 2. Buy. All right, so we are now up $1. We're up $1 on the trade. 475, we put it on for 465. I mean, if you didn't want to take the risk of what might happen to the market after the Fed, I mean, that's the reason why I would get out of the trade. This is actually trading right where you'd want it. This is exactly where you would like it to be at this point in time, and that we're a little bit on the bull side. Remember, we opened the wing. This is 335, 345. That's 5 points. And the short spread is 345, 350. That's, this is 10 points and this is 5 points. That means it's going to trade for 5 if it goes above 350. So right here is like a perfect area for it to sit. We'd rather have it sit here than down below, mainly because all the risk exists below 335. So let me send that to the what if calculator. And there you have it. This is where we're at. Well, we didn't do it for 470, so this isn't going to show you the right numbers, right? Because we did it for basically 365 is what my screenshot said. So we have more upside than what this is showing, but that is the profit and loss graph. We want the market to come down, sit right in here, but if it continues on up, we're fine. You can close it out and take a profit right now if you were worried about the earning or about the Fed coming up, not the earnings, the Fed. All right. Any questions about the two trades this week at all? I mean, I think we're going to be short and sweet. I said 25 minutes. We're at 11:17 right now. Did anybody do the I wasn't a big seller of the SPX trade, but did anybody do it on Friday? Did they turn out all right on the trade? If you did, let us know. I don't see any other questions or any other comments. So with that said, we're going to have a short and sweet Options Guide TV. Big day on Wednesday. So we will be meeting prior to the Fed meeting prior to the Fed meeting. So we won't have the information that we really need to trade on Wednesday as far as SPX is concerned. I do like the gold trade. And if I get an opportunity to get out prior to that and not have to take the risk of the meeting, we will. And you could also look at the UNH trade that way too. So thanks for stopping in. We'll see you this Wednesday for the next edition of Options Guide TV. And stay safe out there, I guess.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.